Hey, welcome. It is January 23rd, Tuesday. We just got the closing bell and we spent most of the day kind of quiet, very similar to yesterday, but the market really started to wake up a tiny bit towards the last hour. So let's take a look at how that developed. You can see intraday, it was just very quiet. It's just bulls and bears, just not really neither one taking control. And let's take a look at volume, actually. Yeah, not too much volume today. Very low. That bar is super low. So not a lot of activity today. So it seems like that people, institutions are really waiting for that GDP number before they'll make a decision on whether they should be positioning themselves long or short for a pullback. We did see activity in that last hour. These lines are actually just from yesterday. And you can see that we reacted to basically the exact same lines as yesterday really well, actually. And it wasn't until that last hour where we broke out, came back and tested it. And then in the last 20 minutes or so, we started to trade back up. So in the last few minutes of the market, a little bit of bullish bias. We'll see if that carries over into tomorrow morning. But so far, it's just very mild, just moving a little bit sideways. If we look at maybe I should get rid of some of these lines. Getting a little cluttered over here. Okay, I'll put them back later. But we can see that we're pretty much moving exactly along this blue line that we drew a few days ago. So it's just very slowly, very quietly moving up towards that 490 resistance level. And the last couple of days, we can really say that it's kind of moving sideways mostly. It is slightly sloped upwards, but we could also interpret this as sideways, a little bit of consolidation, which is actually healthy for the market to move up a little bit. Just like this sideways consolidation was healthy for the next move up, this sideways consolidation was allowed for the next move up. This sideways consolidation then pulled back, allowed for this move up. If this consolidates, then we can hit that 490 and possibly 500. But again, we are looking for some sort of pullback, some sort of a correction sometime somewhat soon, just not in the immediate future, just not in the next few days or necessarily even the next 1 to 2 weeks. This is moving pretty much along what we expected, and it's going pretty well. So if we look at QQQ looking like we're at all-time highs. We hit all-time high yesterday, and we just went sideways today. So very similar story in QQQ. DIA looks like we hit that high yesterday, and then we pulled back a tiny little bit on a larger time scale. This could just be consolidation, but on a one day to the next, we are down a little bit. Actually, not that meaningful, 0.27%, mostly just random, mostly just noise. We're not even to that EMA 8 yet. So we could creep down a little bit more. We could still call that sideways movement. But for now, it is looking like it's pretty healthy, pretty strong for it to move up at least a little bit higher. So that 490 level really is looking very good so far for a short-term level in the S&P 500. What we'll want to see is we already know that in terms of news, we don't have much going on until Thursday, until we get the GDP. We'll want to take a look at bonds. We'll want to take a look at earnings. So let's do those. TLT. So today we came back down. Yesterday we were saying how it pulled back to the EMA 8, but we weren't really trustful of it. And so this is back down to the day before yesterday. So, and again, below its MA 50 and MA 150. That's not looking really great for bonds. It really does look like we are heading down this slope right here. So maybe not that low, but I'll draw it maybe out to here for now. So that will put some pressure on stocks, but in the short term, temporarily, well, I guess not necessarily temporarily, the earnings will take precedence over the monetary policy or the interest rates. It's just that interest rates are always there. The earnings are seasonal. So once the earnings season is over, then the interest rate could take over again. And what's happening right now is with this Fed Watch tool, we are seeing that the market is expecting with less likelihood that we are going to get that rate hike in March, or sorry, rate cut in March. So today is about the same as yesterday. We're really only 0.2 difference between the two yesterday, but we came down from like 87, almost 90%, now all down to 47% chance that we're going to get that rate cut. What we want to see, what's more important is, rather than the precise timing of rate cuts, is do we get rate cuts sometime this year? And how many rate cuts do we get this year? So the market, for whatever reason, is pricing in possibly 6. The Fed is talking about possibly 3, but so far, no news of action on those cuts. So if the market begins to expect that there's going to be fewer, so if we're pricing in 6 right now, and we think eventually the market thinks that we're only going to get 3, then there has to be a correction. These bond rates will come down, but more importantly for us is in the S&P, right now what's happening is we haven't pulled back down. We expect, and what would be normal is that the rates and the bonds would drag down the equities markets. But what the equity investors are basically saying right now with their price action is, okay, fine, maybe it doesn't happen in March, or it's not as likely that it'll happen in March that we thought, but it's still going to happen. If it doesn't happen in March, it'll happen in April. And we're still going to get 6. They're just going to be all clumped together towards the end. And so that's why we haven't pulled back yet. But if we start expecting 5, 4, 3 rate cuts instead of 6 rate cuts, then you will see that actual pullback. We just have to wait. And of course, the longer we go into the year, the more likely it is that we'll get fewer rate cuts. You can see these are the scheduled meetings. 1, 2, 3, 4, 5, 6, 7, 8. So if we pass the first 2 without any rate cuts, then suddenly what we're saying is every single meeting after that, they're going to have to do a 25 basis point cut. Or if that doesn't happen, then one of these subsequently, at least one of them would have to have a 50 basis point cut, which is not too likely. That would be really, really aggressive. So if those expectations, as we get closer to March, it becomes more likely that we have fewer rate cuts, and that will cause a pullback or a correction in the markets. So that's something to keep in mind, something to watch out for. We're also going to look out for earnings. Let's find specifically what's reporting tomorrow or today after market. Today after market. Netflix, that's going to be big. So especially in the communication sector, tech communication sectors. Texas Instrument, also tech semiconductors. That's going to Steel Dynamics. So it's not huge, but it will give us an important indicator for the materials. And ISRG is a pretty big name inside the healthcare sector. So these are some pretty big, important numbers coming out in terms of earnings. And then tomorrow before market, Abbott is a large one in healthcare. Freeport McMoran is big in materials. GD, big in industrials. Kimberly-Clark for staples. Progressive in financials. Okay, so we have tomorrow will be kind of important. It'll be very important or very interesting to watch and see what happens as we get those to the S&P post-market and pre-market as we get those earnings reports. So it might be interesting to watch futures overnight, or at the very least tomorrow morning, we're going to take a very, very, very careful look at the futures markets before we open up, because there could be more volatility tomorrow than we've had today or yesterday. And for sure by Thursday, we should start to get volume back into this market. This is low. This is surprisingly low actually for today. I would have thought at least maybe matching this bar right here. But sometimes our volume data takes a while to catch up. So we may get tabulated. This bar may come up a little bit later, or if we look at it tomorrow. Last thing that I want to take a look at is the fear and greed. Fear and greed, we're still up at greed. We didn't get into extreme greed for very long, just a couple of days. We're still pretty high in this greed index. So the longer we stay up here, the more we need to come back into a fear or extreme fear in order to balance that out inside of the markets. But for now, the trend is up. There doesn't look like there's any real signs of it slowing down imminently, although perhaps in a couple of weeks. So we still want to be biased to the long side, but very, very cautious for a potential pullback. So that fear index reminded me of VIX. Let's take a look at our CPC and our VIX. We haven't looked at those in a while. CPC is not telling us anything. VIX. Okay, so this is interesting. Our VIX has come down for the past, I guess this was flat, but over the last 4 sessions, our VIX has come down. Let's take a look at what our S&P did. 1, 2, 3, 4. Okay, so these first 3 make sense. Today to yesterday to today, we're basically flat, just a tiny bit up. But when we looked at that VIX, what we saw was that the VIX came pretty significantly down today. So a tiny move up should be a tiny movement down in the VIX, not a full length bar like this. If we see this movement from these 2 days, so this change to this change was about 1%, and this is a 5% change. So yesterday in SPY, we had a 0.2% move, and today we had a 0.29% move. Very similar in size, but a huge difference in the change in VIX. So that's telling me that at least in the very short term, the bulls have a little bit more control. They don't have so much more control that it actually showed up significantly in the prices, but underlying, it's like you have a tug of war and you have 2 teams and it looks even, but one team is starting to get tired and the other team is still has a lot of stamina left. So it looks like the bulls are slowly just have a little bit more in them. So I don't see any reason, at least at the moment, why we won't continue this steady rise upwards into that 490 level. All right, so again, we want to be biased to the long side and just pretty much balanced in our portfolios. We just want to watch out. These are times that we want to be careful because we don't want to get too long or caught off too far off center, because any pullback could really hurt that portfolio. So you just want to take a very balanced approach at the moment. Okay, so that is going to be it for today, and I'll see you guys tomorrow morning.